Hello and welcome to Hot Money on BloombergQuint Live, India's first digital live streaming business news service. This is a show which gives you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts then, Nirali, Shah of Samco Securities, along with independent investment advisor Vivek, Mavani, and Vinit Bolinjkar of Ventura Securities join me on the show. Thank you to all of my guests for joining me. On the show today, we analyze the results of Reliance Industries. We also discuss whether BHEL and the news of the potential divestment makes it an attractive bet. We discuss Nestle and whether the rally in the stock will continue. And lastly, we ask our analyst about one stock that our analysts feel delivered strong results in the second quarter. So that's something that we will discuss as of now. The first question we want to discuss, and that is Reliance Industries came out with numbers, not the best of numbers. It was actually the refining numbers that were rather weak. Jio also didn't provide any fireworks. But Reliance, the big boy now, about the 9 lakh crore market cap. What should one do in Reliance Industries? Is there more upside potential left in the counter? That's something that we will discuss. So with our guest, Vinit, what did you make of Reliance earnings, and does Reliance have now more legs to move forward?
So petchem will be a soft spot, but because of this IMO regulations post December, I think the margins will improve. But on the apart from the margins, there will be a trade-off in terms of weakness in volumes. So it would kind of neutralize. But I think Jio has hit bottom in terms of pricing, and with the first step of not wanting to accept ICU anymore, IUC anymore, will mean that there would be more upgrades to follow in terms of plan benefits to the company.
Hasn't that been priced in for the IUC charges that was said?
Yeah, so I'm saying the IUC was one of the elements which was which is a suggestion that the rates have completely bottomed out. They cannot take any more losses on their books. So I think that's a good trend for the entire telecom sector. Retail continues to do well, and I think over the next 2 to 3 years, the oil and gas space will also start firing because of KG-D6 and the new assets which will come on stream. So I think that we have still got enough levers of growth in the company, and the debt reduction which is impending is also going to add to the flavor.
What according to you will be the few key triggers? Let's say retail. Where are you seeing growth come in? Will the next growth?
So I think retail will be the biggest in terms of growth. Second would be Jio. I think we will benefit in terms of pricing. And third would be oil and gas, which could surprise, followed by a little bit on refining, and then finally by petchem.
Okay, what's your sense, Nirali? What did you all make of the numbers? What have you advised your clients on Reliance?
So I think the numbers were largely in line with expectations, and Jio made like a 40% growth in PAT and margins, and on the consumption and the retail end also there were very strong numbers, and now their consumption centric business is 1/3 of the total EBITDA. So basically the company, I think, is in the right direction to focus on the market, or increasing its market share of the consumer business to almost 50%. And basically there will be value unlocking in the consumer business, also deleveraging of the balance sheet, which are going to act as catalysts for the company going forward. And if you look at the refining business, then the margin ramp up can be because of the petcoke gasification project, and as he said, the revised IMO implementation, which will be from Jan 2020. So because of that, Reliance is a good bet in the future. But if you see, the PE ratio as of now is around 21 times, and the average growth is 20%, which makes the PEG at around 1. So looking at a cyclical business with a PEG 1, we feel there is low margin of safety. So as of now, I will advise investors to wait for a correction before actually getting into the stock.
Okay, wait for a correction. Vivek, what's your sense? What did you make of the numbers?
Well, 2-3 things. I do second what Vinit and Nirali have mentioned about the Reliance numbers. Jio and retail are the new growth drivers, and as far as the telecom business, the Jio is concerned, in terms of the loss funding, in terms of capital expenditure, in terms of I mean the worst certainly seems to be over as far as the telecom or the Geo business is concerned. So from here on, we should see expansion of margins, improvement in return on capital, return on equity for Geo standalone, and hence also for RIL on a consolidated basis as well. That's number one. Number two, the concerns on debt, I think, have also peaked out. The debt seems to have peaked out. So now if we look at the last 2 quarters, there's a very sharp narrowing between cash profits and capital expenditure. Probably from the current quarter, cash profits will be higher than capital expenditure, which will be one of the reasons as to repayment of the debt. We didn't surprisingly hear anything about the Aramco deal, Aramco intending to take a stake in the RIL's oil and gas business, which is what was supposed to result in the bulk of the deleveraging of the balance sheet. I assume it is still work in process, and we should probably hear in the next quarter or two. But from what it is in terms of operations, as long as over the next couple of years we see improving margins and improving return on equity, return on capital driven by Geo and the retail business, even where the oil and gas and petrochemical business are probably going through a muted performance or a slowdown, whatever way you put it, at about maybe 18 times current year earnings and maybe about 16 times forward earnings, I think it's reasonable. So on declines, I would be a buyer. Not that I have a great love for companies which have only 11% return on equity, return on capital. The whole bet is about deleveraging and increasing ROC, ROE, which is why they accumulate. Otherwise, my views have been well known that I've not really had a liking, or I still don't have a liking for companies which have very low return on capital and return on equity.
My only thing is, you said that debt seems to be they haven't increased the debt, but you think they have enough levers to reduce debt going ahead. But at the end of the day, 2 lakh crore is still a large amount of debt on the
of course. But 2 lakh crores is large. But as I mentioned, if the investment phase across all businesses is done with, that is a key assumption we are making, because in Reliance over the last 25 years, I mean, the investment phase just doesn't come to an end. They just keep investing in newer and newer projects and larger projects, expansions, new businesses, and so on and so forth. But here the assumption is that what is the business profile stays, much of the investment is done with, and now is harvesting time, and cash profits higher than annual capital expenditure is what will hopefully lead to deleveraging. I mean, hopefully the cash profits will be used for repaying debt rather than create new investment avenues.
Okay, so that's the view that's coming in on Reliance Industries. Inline set of numbers, buy now or buy on decline seems to be the call that's coming in on Reliance Industries. The second stock we want to talk about is BHEL. I don't know what the stock is doing today, but on Friday, a massive 25% move that came out on the news from one of the channels that came in terms of government looking to get their stake down significantly and sell off and privatize the company. It's been a massive underperformer, BHEL, at this point of time. But this potential divestment news did manage to put in the trigger. Nirali, news aside, what's your sense on BHEL and the capital goods space? You think, first of all, will there be buyers for an asset like BHEL, and what should one do for an investment in BHEL?
So particularly for BHEL, since the last 10 years, the stock has been a massive wealth destructor, and like from highs of 300 to 54, 50 levels. So basically, I feel that this move is temporary, and there is no rally like going to be in BHEL henceforth. And fundamentally also, I think it is a very weak stock, because the PAT and top lines are negative and ROE is a mere 1%. The major risk for the company is their receivable days, which is extremely high, almost 255 days, and 80% of their receivables is from the public sector. So because of the tightening conditions, I don't think it is very easy for them to reduce their receivable days. So that is one major risk for the company. Also, the rising preference towards, if you see, renewable sources of energy and the transmission lower reduction rates. So because of that, I think the outlook for the sector for thermal energy is negative going forward. And therefore, I would tell our investors to actually avoid the stock for now. Coming to the disinvestment, I think it will be very difficult for the government to carry on this, because I don't think there will be a lot of buyers who can bring around the turnaround in the company.
Okay, Vinit, what's your sense? Do you think that BHEL will have takers if the government decides to divest it?
Yes, I think they could have takers, and anyone who has a long-term outlook to India could definitely pick it up, and any of the existing peers and incumbents could take it up. Having said that, that's a very if and but kind of scenario. But if you look at the actual position right now, it's not very encouraging, as Nirali pointed out. So we have got thermal capacity which is going to not get incorporated as the government wishes to think, because the demand is very weak. And we've had these they've had a 10 gigawatt order book for a very long time, but the execution does not come through, and there are too many moving parts there in terms of the cash cycle. So I think that while this business is a no-go investment as of now, one should have a view on this stock and track it more for any kind of incumbents coming and taking it over.
But on the fundamental side, you believe it's weak. On a standalone basis, if this deal doesn't go through,
basis, if this deal doesn't go through, it's a forgotten stock.
And what about your view on the capital goods sector? Will the other private sector companies also face similar issues, because they have been facing issues?
Yeah, but you know what? There is a lot of bidding going on out here. So there is 140,000 to 150,000 crores of order book which is coming in, and L&T's power business is quite low in terms of utilization. So they're coming here to bid, and these are better and more efficient players. So what does BHEL suffer from? It's actually inefficiency. So you're overstaffed, and your costs are very high. So these other players, the private players, have been winning businesses from BHEL. So I am not very negative on the sector. I think we are going to have a huge power deficit if you take a 10 to 15 year view. So I think any player would want to take over this company.
Okay, what's your sense, Vivek, on both the scenarios, on the company itself, and do you think that there could be potential buyers for BHEL?
Well, a company itself, I mean, the fundamentals certainly are weak. I mean, in the sense, BHEL has been constrained in the last 10 years on two counts. One is a macroeconomic scenario where new thermal capacity coming or new projects for coming have been significantly lower than the previous 10 years. I mean, last 10 years versus the previous 10 years, that's number one. Number two, in terms of technology, BHEL has certainly lagged, and one of the reasons of not being adequately competitive compared to some of the private players is also the access to technology, which BHEL has been constrained in the last 10 years to have that. Third, in terms of in the next 5 years, will huge amount of thermal capacity come on will be planned and come on stream? It is doubtful for two reasons. One is, as Vinit pointed out, that the demand scenario on power is not so strong that requires huge amounts of new thermal capacity to be planned and executed. The second is huge amount of incremental capacity in power is coming from renewables, solar being one of them. The increase in demand in power is also partly being met by renewables. Government's focus is on renewables, and BHEL is practically, you could say, absent. BHEL does do some solar projects and does have some orders, but it is not enough to compensate for the lack of order book momentum or new projects momentum in the thermal space, and BHEL's fortunes are tied to the thermal. The other part of the business in BHEL, which is interesting, which is industrial and railways. I mean, they make electric locomotives for railways. There also, I would have hoped that given the huge amount of investment planned by railways, but still doesn't adequately compensate for the thermal power. So all in all, BHEL is in a difficult spot in terms of the viability and sustainable future of their business itself. Now, about the privatization and strategic sale, the news which have been coming from the government that BHEL is on the list. I mean, obviously, there's not been actually a formal communication from the Ministry of Finance. These are just some kind of guesses or leaks from the finance ministry. But assuming that were to happen, for a potential buyer, I mean, has to still grapple with the same challenges, which, I mean, whether the ownership is with the government or with the private player. The challenges BHEL faces still need to be addressed, and those will not get addressed anytime soon. Now, whether there will be enough interest among the private players or any of the foreign players wanting to take over BHEL, well, everything is dependent on the price. I mean, if the government, I mean, just for argument's sake, at 150 will somebody be interested in BHEL? It's unlikely. At 50 rupees will somebody be interested? Maybe there may be a few players who may be interested. But to me as an investor, or to you as an investor, does it make sense to buy from a short, medium or long-term point of view, whether it's for trade or for investment at the current price of 50, 55 or 53 rupees as your screen says? I don't think there's really a meaningful trade over here.
Okay, that's the view that's coming in on BHEL. Nothing much on the fundamentals of the company unless some bit of news comes in terms of divestment. The next topic we want to talk about is Nestle India. Now, it's proving everyone wrong, those people who actually even talk about valuations at levels of 15,000 now. So it's managed to rally significantly. One of the biggest outperformers, it's up 50% in the last 12 months, got included in the Nifty. Will the rally continue? It's one of the most expensive stocks. So in fact, one of the 10 most expensive stocks that trade in India currently in the basis of price to earnings valuation. Vivek, will the rally continue, or now are valuations getting too steep for someone to get into it?
Well, valuations certainly are steep. Valuations have been steep even 6 months ago, even 12 months ago, even 24 months ago. And the same can be said for large number of stocks in the consumer space, companies which have been delivering good results or growth quarter after quarter, year after year, and have no balance sheet or corporate governance issues. Unfortunately, Nestle is in that category. So what we have seen over the last 2 years is a clear polarization in the market of good quality stocks which deliver performance, have no balance sheet or leverage and management or governance issues, versus companies which have any of the 3 or 4 other problems. So the good continue to get expensive and the bad continue to get sold into, and that's across the board, whether it's consumer stocks, whether it is banking, whether it is the IT stocks, or you name the sector. And so that clear polarization. Now, as far as Nestle is concerned, it's a clear play on increasing consumption, premiumization of consumption, urbanization, changing consumption habits. Nestle is a leverage on that, where most of the product categories of Nestle, there's a huge runway for growth over the next 10-15 years, given the inadequate penetration versus a very large penetration in, say, categories where HUL is present. I mean, soaps, detergents, tea, for example, or even personal products to a certain extent. As far as Nestle is concerned, the consistency of their growth over the last 20 years, very high dividend payouts, return on capital, return on equity upwards of 70%. I mean, very few companies, not even 10 companies in India can match the kind of consistency and the performance track record of Nestle. So will the rally continue? Well, so long as they continue to deliver results and so long as this polarization in the market continues, it will probably stay expensive. The only way it can get reasonable is a stock gets into some sort of a consolidation or a narrow price band while the earnings catch up, and hence over maybe 6 to 8 or 12 quarters, the multiples start looking more reasonable. But to think that there will be a sharp correction and the stock will fall from 80 times earnings to 40 times earnings, well, I clearly don't see that scenario, at least at this point of time.
Nirali, what's your sense on Nestle? What have you advised your investors to buy this or no?
So basically, there's one fact I'd like to point out, that statistically it has seen that 2 out of 3 companies that have been included in Nifty 50, after inclusion in 1 year, they've given negative returns.
Yeah, that's a fact, yes.
So now, because Nestle's rally recently was due to its earnings and growth and all the fundamentals that Vivek pointed out, it is high from a valuation perspective, but its average PE has been around 50-60. So there can be, and also if you see, the MD isn't very gung-ho about the double-digit growth that the company should have. So that is why I feel that this is not the time for fresh investments, but investors who already hold the stock should continue, because like the promoter himself has 62% stake, and he has been holding since over 9 years. There's brand value.
Okay.
So because of that, this is my view on Nestle.
Okay, what's your sense, Vinit? How should one approach Nestle?
So I think you should buy it on declines. Obviously, the valuations are steep, but you know, it is one company which has got the best run rate of innovation. So 70% of their products are hits. They've done 61 to 62 innovations over the last 2-3 years, and they're doing very well. So if you take that fusion noodles which they had launched, and the kind of initial response that it has got, and you know, if you look at the focus breakup of the business, it's more 75% urban, and in a market which is declining, you know, where the rural stress is there, you know, this guy remains largely unaffected. So I think, and they have got the pricing power. So I am very gung ho on the business, but the valuations are steep.
Okay, that's the view that's coming in on Nestle. Everyone's bullish on the counter overall, but yes, valuation is something that you need to watch out for. A bit of correction is something that can be looked as an opportunity to accumulate as per the expert. And the final stock is we're in the midst of earnings season, lots of earnings out. We're asking our guest one earnings that surprised them in the second quarter. Any earnings that you saw that, you know, was that caught your eye?
So one company which is under the radar for most investors is Cocoa Camlin. It's a small cap stock. It does annual turnover about 600 to 700 crores. But what was very interesting during this result is that it has thrown up significant cash flows. Although the revenue has declined, profitability is up, and its cash conversion cycle has really been tightened. So I think that, you know, considering the fact that, you know, the way all consumer businesses have grown, you know, the demographics is playing out, and we've got a huge young population which Cocoa Camlin adheres to. They finished their capex, and I think we are in for good times to roll going out.
Okay, and the second quarter numbers were the balance sheet items were much better. That's
balance sheet items were much better. Second quarter, the revenue was 136 crores versus 143 crores, but we've seen the EBITDA and PAT improve significantly.
Okay, so this is one stock that you're watching out for. It's given negative returns of 35%, but that's after the result, a little bit of spike that came out. Nirali, which was the result that surprised you this time?
It was MCX actually.
Okay.
The volume growth this time was around 40%, mainly due to the volatility of gold and crude. So basically, the bottom line increased almost 100%, and top line was 55% growth. So because of this, the core metrics are in place. Also, the innovation done by the company to start commodity options and increasing active participation by waiving of the transaction fee, I think is a very smart move. Also with a 92% market share that it enjoys, I feel MCX is extremely attractive. From a valuation perspective as well, 24 times P is a good price to buy MCX. So that is what I would suggest investors at this point.
Okay, so surprising result from MCX. And Vivek, finally, which stock did surprise you?
Well, we have actually just 2 weeks into the result season, and so large number of results are still pending. But among the ones who have declared results, I mean, I found HDFC Bank to be quite pleasing. I mean, really no surprises amidst a huge amount of negative surprises coming up in the market every second day. HDFC Bank, the juggernaut of growth continues, driven by a mix of both retail and corporate growing well. Very good underwriting of their loan book, and very sharp monitoring, keeping NPAs at just about 1%. So as far as HDFC Bank is concerned, from a valuation point of view, I mean, it's about 3.7 times price to book, about 3.4, 3.5 times on a forward basis, which has been lower than what the historical average. Historical average is 4 or upwards of 4 if you take last 5 years or last 10 years averages. And the related point which I was mentioning earlier, the polarization in the market for good quality versus not so good quality, or the preferred stocks in preferred sectors versus not something preferred. I mean, HDFC Bank again is on the side where there is unlikely to be a significant sell-off, It may relatively be looking expensive, but relatively it has also delivered better growth. Relatively, the business profile is much better. Balance sheet is of better quality. I mean, on every metrics, relatively HDFC Bank, Kotak Bank, of course, is also there, better than every other bank or every other NBFC. The one big trigger or positive trigger could be the IPO of HDB Financial, which is the NBFC subsidiary of HDFC Bank. Sometime in the next 1 or 2 years, it will happen. But nevertheless, at the current price, I mean, I would be a buyer on declines if there are any.
Okay, that's the view that's coming in on HDFC Bank. So HDFC Bank, MCX and Coco Camlin were the three counters that were spoken in terms of the earnings. But with that, it's a wrap on today's edition of Hot Money. Let me thank my guests who've come in today, Nirali, Vivek, as well as Vinit. Thank you so much for coming in today. Ask BQ comes up next. Stay tuned to BloombergQuint.